Fed's plan, rate cut followed by major hike. The Federal Reserve's actions significantly influence the economy, and understanding these impacts can help you make informed financial decisions. Today, we'll explore the long-term debt cycle, its historical context, and what the future might hold. The Federal Reserve and interest rate predictions. For years, many anticipated that the Federal Reserve would cut interest rates. However, due to persistent, record-breaking inflation, these predictions have not materialized. But now, there is a growing consensus that the Fed might soon lower rates, at least in the short term. At All Things Money, we focus on educating regular people about financial techniques that are often overlooked by mainstream advisors. One such technique is understanding and navigating the long-term debt cycle. Understanding the long-term debt cycle. Financially, the current state of our country is not unprecedented. By looking back to the early 1940s, when the U.S. debt to GDP ratio was around 120%, the same as it is today, we can gain valuable insights. Over the next 40 years, the government successfully deleveraged, reducing the debt to GDP ratio. However, from the early 1980s onwards, the ratio began to rise again, culminating in the current levels. The current debt cycle phase. We are now entering a phase that will likely mirror the deleveraging period from the 1940s to the 1980s. This means that the next few decades will involve reducing the debt to GDP ratio, which will push both prices and interest rates higher for longer periods. Short-term versus long-term cycles. While we are in a long-term debt cycle, short-term cycles drive its dynamics. Currently, the government faces severe financing problems and must borrow more money, leading to higher interest rates. This borrowing cycle creates a feedback loop, increasing the government's interest expenses and driving rates even higher. The Federal Reserve's role. The Federal Reserve can intervene in two ways. 1. Lowering interest rates for the U.S. government. 2. Buying government debt through quantitative easing, QE. These actions make it easier for the government to spend, but they also drive inflation higher. As a result, interest rates for everyone else increase to protect lenders from currency debasement. Historical context. Despite efforts to control interest rates and inflation through measures like yield curve control, higher rates persisted from the 1940s through the 1980s. The Federal Reserve had to intervene multiple times, resulting in a cycle of borrowing, spending, and rising rates. Potential future scenarios. In the 1970s, delinking from the gold standard led to significant inflation and higher interest rates. Today, we could see similar scenarios involving massive rounds of debt monetization or QE. As the economy shows signs of stress, the Fed may lower rates temporarily, leading to higher inflation and rates in the long term. Protecting your wealth. To safeguard your wealth, 1. Invest in hard assets. These assets appreciate from currency dilution rather than being hurt by it. 2. Expect volatility. Central planning often leads to unforeseen consequences, creating opportunities for astute investors. Staying informed. Active wealth management is crucial in these times. If you're looking for guidance, consider subscribing to our channel, All Things Money. It's free and offers in-depth analysis on financial topics that can help you protect and grow your wealth. Conclusion. Understanding the long-term debt cycle and the Federal Reserve's role can help you make better financial decisions. Stay informed, and you'll be better prepared to navigate these complex economic times.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.